What if I told you that the safest thing in your retirement plan might actually be costing you money? I'm not talking about stocks. I'm not talking about crypto. I'm talking about CDs, bonds, the things your parents told you were safe, the things your banker probably still recommends today. Here's the uncomfortable truth. For decades, CDs and bonds were the gold standard for conservative savers. And in many ways, they still feel safe because they're familiar. But familiar isn't the same as optimal. And in today's retirement environment, relying exclusively on CDs and bonds could mean leaving thousands of dollars on the table every single year and potentially paying more in taxes than you have to. So today, I'm going to show you 3 powerful, safe money alternatives that most financial professionals never bring up. Alternatives that give you principal protection, growth potential, and some serious tax advantages, all without putting your hard-earned savings at risk. Stay with me, because by the end of this video, you're going to see retirement saving in a whole new way. Now, before I introduce the alternatives, I want to be clear about something. I'm not here to tell you that CDs and bonds are bad. They're not. They have their place. But I am here to tell you that if they're the only tools in your safe money toolbox, you may have some blind spots worth examining. Let's start with CDs. When you put money in a CD, you're essentially lending your money to a bank for a fixed period, 6 months, 1 year, 5 years. And in return, they pay you a guaranteed interest rate. Simple, predictable, and yes, FDIC insured up to $250,000 per depositor. But here's what doesn't get talked about enough. Every dollar of interest a CD earns is taxable as ordinary income in the year you earn it, even if you don't touch it. So if your CD earns $5,000 in interest, you're writing a check to the IRS that year, period. And when your CD matures and it's time to renew, you're at the mercy of whatever interest rates are at the moment. There's no upside participation, no growth beyond what the bank decides to offer you. Now let's talk about bonds. Bonds are often called safe because they're not stocks, but bonds carry their own very real risk, and it's called interest rate risk. Here's how it works. When interest rates rise, the value of existing bonds falls. So if you're holding a bond and rates go up, your bond is worth less than what you paid for it. If you need to sell before maturity, you could lose principal. And just like CDs, the interest bonds pay is taxable income every year. And here's the part that really matters for retirees and pre-retirees specifically. All of that taxable interest income can have a ripple effect. It can cause up to 85% of your Social Security benefits to become taxable. And it can push your income high enough to trigger IRMAA. That's the income-related monthly adjustment amount, which means you'd pay higher Medicare Part B and Part D premiums. We'll come back to that in a few minutes because it's a really important piece of this puzzle. Bottom line, CDs and bonds aren't villains. But in 2024 and beyond, a conservative investor deserves to know that there are better options on the table. So let's look at them. The first alternative I want to talk about is fixed indexed annuities, or FIAs. And I know, the word annuity can make people nervous. There's a lot of misinformation out there. So I want to walk you through exactly what a fixed index annuity is in plain English so you can make an informed decision. A fixed indexed annuity is a contract between you and an insurance company. You place a lump sum or sometimes a series of payments, and in return, the insurance company credits interest to your account based on the performance of a market index, like the S&P 500. But, and this is key, you are not directly invested in the stock market. Think of it this way. Imagine you could go to a casino and play a game where if the slot machine wins, you get a portion of that winnings. But if it loses, you get your money back. No loss. That's essentially the structure of a fixed indexed annuity. Here's how the protection works. FIAs have what's called a floor, and that floor is typically 0%, meaning in any year the index goes down, your account doesn't go down with it. You simply earn zero interest for that period. Your principal is protected. Now, in exchange for that protection, there are limits on the upside. These are called caps or participation rates. A cap might say you earn up to 10% in a given year, even if the index earned 20%. A participation rate may say you receive 50% of whatever the index gains. Every product is different, and that's where working with a knowledgeable agent makes all the difference. But here's what makes FIAs really stand out compared to CDs and bonds. Tax-deferred growth. Inside a fixed indexed annuity, your money grows without generating a taxable event each year. You don't get a 1099 every January for interest you earned. You don't owe the IRS anything until you actually take a distribution. This means your money is compounding on the full balance, not the after-tax balance, year after year. Over a decade, that difference can be substantial. And for those of you thinking about guaranteed income, many fixed indexed annuities offer something called an income rider, sometimes called a GLWB, a guaranteed lifetime withdrawal benefit. This is optional, and it's an add-on that can essentially create your own personal pension. You turn on the income when you're ready, and it pays you for life, regardless of how the market performs and regardless of how long you live. Now, I want to be transparent with you because I believe in giving you the full picture. Fixed indexed annuities are long-term vehicles. Most have surrender periods, typically between 5 and 10 years, during which withdrawing more than a certain amount can result in a penalty. They are not designed to replace your liquid emergency fund. They're designed to be a cornerstone of your long-term retirement income strategy. If you're a conservative investor with a 5 to 10 year time horizon who wants principal protection, the potential for meaningful growth, and the option for lifetime income, a fixed indexed annuity deserves a serious look. The second alternative is a duo, Treasury Inflation Protected Securities, known as TIPS, and I-bonds. Both are issued by the U.S. government, which means they carry essentially zero credit risk. And both are specifically designed to do something CDs and most bonds cannot do: keep pace with inflation. Let's start with I-bonds. I-bonds are savings bonds issued directly by the U.S. Treasury. The interest rate they pay is tied to inflation, specifically the Consumer Price Index. When inflation is high, I-bonds pay more. When inflation cools, they pay less. The interest you earn is tax deferred until you redeem the bond and is exempt from state and local income taxes entirely. Sounds pretty great, right? There's one significant limitation. You can only purchase $10,000 worth of I-bonds per person per year through treasurydirect.gov. So they're not a solution for deploying large sums of money. But as part of a diversified, safe money strategy, they're a solid inflation hedge. TIPS work a little differently. Instead of the interest rate adjusting, the principal adjusts with inflation. So if inflation rises, your principal goes up. And since your interest is paid on a percentage of that principal, your interest payments rise too. TIPS can be purchased directly from the Treasury or held through a mutual fund or ETF. The one nuance to be aware of: TIPS generate something called phantom income, meaning if your principal increases due to inflation, you owe federal tax on that increase even if you didn't receive the cash. That's worth discussing with a tax professional before jumping in. The bottom line on TIPS and I-bonds: they're not high growth vehicles, but they do exactly what a conservative investor in an inflationary environment needs. They protect the purchasing power of your money, and that's a job CDs have historically struggled to do. The third alternative is one I like to call the CD's smarter cousin, the Multi-Year Guaranteed Annuity, or MYGA. Here's a simple version. A MYGA works almost exactly like a CD. You put in a lump sum, you get a guaranteed fixed interest rate for a set period, 3 years, 5 years, 7 years. At the end of that term, you get your principal back, plus all the interest earned. So why would you choose a MYGA over a CD? Two big reasons: rate and taxes. On the rate side, MYGAs, especially in competitive interest rate environments, often pay meaningfully higher rates than CDs of comparable terms. That's because insurance companies invest your premium in their general account, which allows them to offer more competitive returns than most banks. On the tax side, this is where MYGAs really shine. Unlike a CD, a MYGA grows tax deferred. You don't get a 1099 every year. You don't owe the IRS anything until you take a distribution. That means your interest is compounding on the full balance, not being chipped away by annual taxes. For someone in a higher tax bracket, the difference in net growth over 5 to 7 years can be significant. And unlike a CD, a MYGA can serve as a bridge to lifetime income. At the end of the term, many MYGAs allow you to annuitize, meaning you can convert the value into a guaranteed income stream for life if you choose. The caveats: MYGAs are not FDIC insured. They're backed by the financial strength of the issuing insurance company. And like fixed indexed annuities, they do have surrender charges if you withdraw more than the allowed free withdrawal amount during the term. But if you're someone who loves the simplicity and predictability of a CD, and you simply want to keep more of your money and let it grow more efficiently, a MYGA is absolutely worth exploring. Now, I want to come back to something I mentioned earlier, because I think it's one of the most underappreciated factors in retirement income planning. When you hold CDs and bonds in a taxable account, the interest they generate is treated as ordinary income every single year. And that matters a lot, because that income doesn't just create a tax bill, it can trigger a cascade of consequences. Here's what I mean. Social Security benefits are not always taxable, but they can be, depending on what the IRS calls your combined income or provisional income. If your income crosses certain thresholds, up to 85% of your Social Security benefits become taxable, and CD and bond interest counts towards that threshold. So the safe interest you're earning could literally be causing your Social Security check to be taxed. And then there's IRMAA, which stands for Income Related Monthly Adjustment Amount. If your income in a given year is above certain levels, Medicare will charge you higher premiums for Part B and Part D, and those surcharges can add hundreds or even thousands of dollars per year to your Medicare costs. And again, CD and bond interest can push you right over those thresholds. Here's why this matters so much in the context of what we've been talking about. Fixed indexed annuities and MYGAs grow tax deferred. That means you control when that income is recognized. You choose when to take distributions, and that control gives you the ability to manage your taxable income in retirement, to stay below Social Security taxation thresholds, to avoid IRMAA brackets, and to keep more of what you've earned. This is the kind of coordinated planning income strategy layered with Social Security and Medicare awareness that can save a retiree thousands of dollars a year. All right, let's bring it all together. When you compare CDs and bonds side by side with fixed index annuities, MYGAs, and TIPS and I-bonds, a few things become crystal clear. CDs and bonds offer principal protection in most cases, but they generate taxable income every year. They have no lifetime income option, and they can quietly push up your Social Security taxes and Medicare premiums without you even realizing it. Fixed index annuities offer principal protection, meaningful growth potential tied to a market index, tax-deferred accumulation, and the option for guaranteed lifetime income. For a conservative investor with a long-term time horizon, they're a powerful tool. MYGAs offer the simplicity and predictability of a CD with higher rates and tax-deferred growth. They're a straightforward upgrade for people who like knowing exactly what they're going to earn. And TIPS and I-bonds fill a specific and important role, protecting your purchasing power from inflation, with government backing and some tax advantages built in. No single tool is right for everyone, but every conservative investor deserves to know that all of these options exist. Here's what I want you to walk away with today. Save money doesn't have to mean settling. It doesn't have to mean watching inflation slowly erode your savings, or paying unnecessary taxes on interest you didn't even spend, or missing out on growth because you didn't know there was a better option available to you. You've worked too hard for that. My name is Shonda Prescott, and this channel, Retirement Security Simplified, exists because I believe every pre-retiree and retiree deserves access to clear, honest, expert-level guidance. As a CPA and a licensed annuity agent, my job is to help you see the full picture so you can make the best possible decision for your retirement. If this video helped you, please get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. If you found this video helpful, please give it a thumbs up. It truly helps this channel reach more people who need this information. And if you haven't subscribed yet, hit that subscribe button and the bell so you don't miss our next video. Because retirement should feel secure, and with the right strategy, it absolutely can. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.